Chevron revenue was $49.73 billion, was down 2%. Worldwide production topped 4 billion barrels of oil equivalent per day, was up 21% year-over-year. U.S. production even stronger, up 27% year-over-year. Obviously, the Hess deal is the big driver there. They are seeing synergies already, CEO said. Legacy Chevron also added another 227 MBED of growth, the Permian, Gulf of Mexico, TCO. Upstream. Their adjusted earnings decreased despite the higher volumes. Upstream took a hit from prices. Brent crude averaged around $69 a barrel this quarter. Last year, same quarter, was $80. However, downstream the focus was this quarter, specifically U.S. downstream. Their adjusted earnings were up over 300% year-over-year. Much higher margins on refined products like gasoline and diesel. Moreover, they benefited from increased capacity at their Pasadena refinery in Texas. When crude oil prices drop rapidly, that's the main input costs for refineries, so their costs go down. But the price of the output, gasoline, diesel, jet fuel, often doesn't fall as quickly or as far. That gap widens the refining margin. It cushions the blow from the lower prices hitting the upstream segment. Total organic capex was $4.4 billion. It's mostly immediate spending needed on those legacy Hess assets. Its 2025 break-even level is about $30 a barrel. Our break-even to cover our capital spending and our dividends. So we are well positioned for a low cycle, even at a $60 price. Our free cash flow will triple from 2024 to 2026 at a $60 oil price. So, our underlying portfolio strength and growth is resilient even in a low price environment. The company ended the quarter with a net leverage ratio of less than 15%. That's comfortably below its 20% to 25% target range and toward the low end of its peer group. The global oil giant expects to produce even more cash flow in the future. Chevron recently completed major capital projects in Kazakhstan and the Gulf of Mexico. Will contribute to increasing free cash flow over the next year. Cash flow from operation, that was $9.4 billion. And if you strip out working capital changes, it was $9.9 billion, was up 20% year-over-year. Despite the $10 lower price environment, cash flow ex working capital jumped 20%. Getting those cost savings program working faster, strong performance from the base business, like TCO and Kazakhstan are key there. It suggests they are producing cheaper and more reliably. Adjusted free cash flow, that came in $7 billion, which is up 50%. A good chunk of that boost, about $1 billion, came from the first loan repayment from their TCO affiliate. Shareholders' return looks strong. They returned $6 billion to shareholders, $3.4 billion in dividends and $2.6 billion in buying back shares. Internal cost savings. They said they've captured about $1.5 billion in annual run rate savings. They are absorbing the Hess acquisition costs while dealing with lower oil prices. Strong financial performance and commitment to shareholder value were key takeaways. We are growing production at a 2 to 3% compound annual growth rate. Demand in the world is growing 1%, so we are growing a bit stronger than overall demand is at $1 billion a year less capital spending, and we announced $1 billion in further costs cuts. Additionally, the company recently achieved a milestone of producing over 1 million barrels of oil equivalent, BOE, per day in the Permian Basin. Its growing production in that key region will also supply it with increasing free cash flow in the coming years. Chevron also aims to deliver $2 billion to $3 billion in structural cost savings by the end of next year. With these savings and rising production, It expects its legacy portfolio to deliver $10 billion in incremental annual free cash flow next year at a $70 Brent price, or $9 billion if Brent averages $60 in 2026. Chevron is approaching a significant inflection point in its free cash flow. New projects, cost savings, and the Hess merger could add up to $12.5 billion in annual free cash flow next year, even with only a slight rise in oil prices. Chevron aims to keep growing its cash flow and cash returns to shareholders into the 2030s.